Hey landlords and blessed investors, I'm Nicole Purvy and here is the real estate news for the week of May 8th, 2023. The Fed increases rates a quarter of a point and signals a potential end to hikes. The Federal Reserve on Wednesday approved its 10th interest rate increase in just a little over a year and dropped a tentative hint that the current tightening cycle is at its end. The Board of Governors of the Federal Reserve System voted unanimously to raise the interest rate paid on reserve balances by 25 basis points to 5.15%, the highest since August 2007. For you newbies, the rate sets what banks charge each other for overnight lending, but feeds through to many consumer debt products such as mortgages, auto loans, and credit cards. Here's a statement from the Fed official press release. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are unlikely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. And then later in the press release, they repeated its goal, stating, the committee is strongly committed to returning inflation to its 2% objective. By the way, the last inflation reading indicated we were at 5%. The next inflation number comes out this week on May 10th. Chairman Jerome Powell in last Wednesday's press conference said a decision on a pause was not made today, but noted the change in the statement language around future policy firming was meaningful. According to CNBC, the post-meeting statement had only offered some clarity on future pace of rate hikes, and not by what it said, but what it didn't say. The document left out some language that it said in previous statements, saying that the committee anticipates that some additional policy firming may be appropriate for the Fed to achieve its 2% inflation goal. The statement changes are an indication that while tight policy could remain in effect, the path ahead is less clear for actual interest rate hikes as policymakers assess incoming data and financial conditions. My opinion, with this new language, I think we'll see an end to the rate hike soon. The Fed has other monetary tightening measures they can do to control inflation outside of rate hikes. I think they'll soon start to lean on those strategies over increasing Fed funds rate. Mortgage rates just went in a shocking direction. What this wild card means for real estate. Mortgage rates slipped lower last week after the May 3rd Fed interest rate hike and went back up only slightly today, Monday, May 8th. Interest rates for the 30-year fixed mortgage averaged 6.39% in the week ending May 4. That's only fractionally lower than 6.43% from the previous week. In midday, Monday, today, May 8th, the 30-year fixed is at 6.125%. We're only one day in, so we can't compare this week's average with last week's average, but many expect mortgage rates to fall even lower later this year, according to Realtor.com. But even with the most recent tick down, rates are still high enough to make home ownership too expensive for many Americans. What's more, many economists increasingly believe the central bank's unrelenting rate hike have been detrimental to the economy, especially in the wake of the most recent bank failure of First Republic. The latest interest rate hike by the Federal Reserve is unnecessary and harmful, said National Association of Realtors chief economist Lawrence Young. Consumer price inflation has been decelerating and will continue. There is significant additional monetary policy tightening already occurring. And given the bank system is on shaky ground right now, Young worries that the Fed might have gone overboard. The fast rate hikes by the Fed have upended the balance sheets of many small regional banks, he continued. They're becoming zombie-like banks, unable to lend even to good businesses as they are more concerned with balance sheet shuffling for survival. Let's talk about exactly why mortgage rates remain a wild card. The chief economist at Realtor.com said mortgage rates remain a big wild card for buyers and sellers as they are highly sensitive to incoming data from the banking sector. Amid all the economic and financial swirl, which may worsen in the weeks ahead as the U.S. approaches the debt ceiling, the U.S. housing market continues to chug along at relatively low levels of activity. After all that, meaning the rate hikes, home prices still haven't stopped climbing. For the week ending April 29th, listing prices inched up 2.4% compared with last year. And with the median price of homes hovering at $430,000 in April, it's no surprise that home buyers are weary and leery of overextending themselves financially. High mortgage rates continue to cast a shadow not only over buyers, but sellers as well. A recent Realtor.com home seller survey found that 82% of prospective sellers are worried about rate lock or having to trade in the ultra low rate on their current home for a much higher one if they were to sell and then try to buy. For the week ending April 29th, 22% fewer new listings hit the market compared with the same time period a year earlier. This downward trend has been going on for a whopping 43 weeks, roughly the same time period that the Fed has been raising rates. And for almost the same amount of time, homes have sat on the market longer, lingering 18 days longer for the last week of April than a year earlier. My opinion, these rate hikes are definitely creating zombie banks. I just recently tried to refi 2 mortgages with a small bank in hopes of getting a lower mortgage, and 2 whole months went by before they even touched my applications, only for them to even tell me we're swamped because we're going through 3 audits. You're right. Y'all scared to touch non-owner occupied rental mortgages, so y'all just stringing me along and I don't have time. Nevertheless, if you have the same problem, just hit Matt up and ask him to hook you up with one of his private lenders for your investment property refis. It might be more expensive, but it is what it is right now. Housing market crash alert: why investors should pay close attention to lumber prices. In an op-ed on Investor Pace News, one writer claims that lumber has a strong predictive relationship with the housing market and can help investors manage portfolio risk. If lumber prices are decreasing, it's likely an indicator that demand for housing materials and housing itself is weak, which could signal a downturn in the broader economy. Currently, lumber prices are at their lowest level since 2020 due to factors such as inflation, rising mortgage rates, and recession risk. Although there have been few instances in history where the housing market actually collapsed, lumber prices have served as a leading indicator in these cases. For example, lumber prices began declining in 2004, more than 2 years before the national home prices started to fall during the financial crisis. Similarly, lumber prices peaked in 2021 and the Case-Shiller National Home Price Index began to decline in mid-2022. While lumber prices have historically been volatile, the evidence suggests that they are closely tied to the housing market. Single-family home starts are a reliable indicator of the residential real estate market, and they have returned to pre-pandemic levels, but remain 30% below 2022 levels. Additionally, building permits have decreased, indicating that the demand for new home has normalized, but home prices remain elevated. The cancellation of new home contracts is also contributing to the slowing housing market trend. Although there was a recent uptick in starts and permits when the economic data, including retail sales and GDP, came in strong, the writer believes this trend may not continue. The housing market may be headed for a correction, which could affect equity investors, as significant corrections in equity markets have historically been associated with pullbacks in lumber prices. Therefore, investors should approach the housing market with caution, given the strong ties between lumber and the housing market. My opinion, I agree with this guy. As a developer, lumber prices definitely dictate my rehab costs, which in turn dictates my exit strategy and its outcome. Pay close attention to lumber prices. Also, there's a whole spiritual thing about lumber. It's all up in the Bible. I'll talk about it in Bible study one of these days, but yeah, lumber is important. Homeowner equity ticks down again. According to MSN, homeowner equity declined modestly for the second straight quarter as home price growth fell across the country, but it remains near historic highs. First quarter results from Adams' 2023 U.S. Home Equity and Underwater Report showed 47.2% of mortgaged residential properties nationwide were considered equity rich, down from 48% in the previous quarter. A property was considered equity rich if the combined estimated outstanding loans on the property was no more than half of the property's estimated market value. And just 3% of homes were seriously underwater, which means that a property's loan balance was at least 25% or more than the estimated market value. Homeowners across the U.S. continue to sit in far better position than they were just a few years ago, with historically elevated levels of wealth built up in their properties. However, the recent downturn in the housing market is chipping away at the bounty they reaped from a decade of price surges. My opinion, I wouldn't pay this too much attention. These equity losses are just market corrections from home values going up 50% during the pandemic.